Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello, and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here with us today. Got a lot of things to go over today. We're going to talk about remote work, how that's affecting the job market and so forth. Also, to special purpose acquisition companies. Well, this is something that was hot a while ago. We're going to talk about how it's not hot now and what could be the next that is not hot, that is hot now. And also, too, very important to us is value stocks. I want to talk about why value investing now could be great in 2024 and many other things to talk about. And with me is Chase. Chase, you got some things to talk about as well, right?
Well, I mean, as always, we're here to answer your questions. That's what the show's based on. So you want to join the show, give us a call here, 833-288-0973. Again, that's 833-288-0973. 0973, and I feel a little off. You know, I was out of the office yesterday at a charity golf tournament.
Yeah,
and
how'd it go?
I mean, I'm terrible at golf, but you know, it's a scramble, so it's fun. So a couple of guys I was with were pretty good. But
right.
You know,
that was for, what was the charity for?
Shelter to Soldiers.
Oh, very good.
Awesome charity. They actually kind of have a dual purpose essentially, where they rescue shelter dogs and they help soldiers with PTSD by pairing them with that shelter dog, train it up, really send them through kind of a extensive process to make sure they are good service animals as well. So I mean, it's a super cool charity. They do a great job there. So I'm happy to support the cause, and you know, it was fun to be out on the golf course at Singing Hills by Sequan. So It was a fun time. Met some good people. Had a fun time. Yeah.
All right, and we forgot to mention, too, that we are the proud investing partners of San Diego Padres, so always want to mention that we love supporting the Padres. But let's talk about finance, and I want to talk about remote work today, because another sign that workers will be coming back to the office was a report that showed tech companies overhired, and that working from home, no surprise here, did not prove to be effective. Year-to-date, tech companies have laid off approximately 168,000 people, and the layoffs are occurring for a couple of reasons. First, they discovered that people were working only, and no surprise here as well, 4 to 5 hours a day, logging in at 11 o'clock in the morning and wrapping up and logging off by 4:30 that same day.
It was also discovered that some tech companies did become overzealous and looked at hiring more people as almost an ego boost, as it was an indication that they felt the business was going to grow rapidly in the future and they would need a lot of employees. Now, part of the hiring was done to keep talented employees from going to the competition, a hoarding of employee talent, so to speak. No matter how you slice it, though, this is not a problem with the economy, but more with tech companies and people working from home. And the other thing, too, we've talked about this a lot on the show, is that these people in these tech positions, the nice thing is most companies in different fields now also need tech.
Yeah.
So they do have a home in terms of finding a new job in many cases. Now, you might not have the cush comfort zone of not logging into a computer till 11 a.m. You might have to go into the office to get that new job, but the jobs are definitely out there.
And that's important for two reasons. The reason why I brought this up this past week and here on the show is it's affecting two things. One, the labor market and the economy. But also, two, you're hearing right now a lot of concerns on commercial property. And what we're seeing, and we've talked about this now, I'd say for the past year, we're seeing this trend of more people coming back into the office, because and I said this 2 years ago, when things slow down, I'm sorry, you're not going to be able to stay at home, because that employer is going to need to get more out of the employees, and they may lay a few people off, so they need more there. So you're going to come back in the office, and we are seeing commercial real estate. It appears to be right now that the main problem is in New York and like San Francisco, and also with Class B and Class C. Class A seems to be doing very well, because these people coming back, like if you want to come back to the office, hey, we got a nice place for you. You got to come back now.
Yeah, and I mean, it's the same concept, and a lot of times I think people miss this. And you've had the last 10 years, essentially, it didn't matter what you did. You bought a Class C office building, yeah, you made money.
Yep.
You bought Bitcoin, yeah, you made money. You bought whatever, essentially. You made money over the last 10 years. And I don't care if it's a stock or if it's real estate. If you buy a bad stock, it doesn't mean you can't make money.
Right.
But at some point, as we always say, the fundamentals matter. It's the same concept in real estate. If you buy a bad piece of property, yeah, you could still make money in theory over a 10-year period because there's so much money in the economy. But again, all of a sudden things slow down. I mean, we've used that saying from Warren Buffett, when the tide goes out, you see who's not wearing a bathing suit.
Right.
It's the same concept in real estate. If you have a bad office building, yeah, I think those are going to have some serious problems now. But again, those Class A buildings, they seem to be doing quite well. And especially for those businesses say, yeah, we need to have a place for our employees to come. They're probably going to be going to those Class A buildings.
And I do want to point out that I was right. Remember a couple of years ago, people said, oh, you're old, you don't get it. The way you used to do business is over. Everybody's going to be working from home in the future. Offices are done. And I said, no, you just don't understand how business works, because as an employer, as a boss, as a manager, as a supervisor, you need to have those people there when you're trying to squeeze out everything you can. Because when times get tough and profits are shorter, you're going to try to squeeze out everything you can. I said, yes, people will come back. No, that's not going to happen. And I do wonder, too, maybe part of the problem with the real estate market is that a lot of people bought homes that were further out.
Yeah.
And now, like, wait a minute, now I got to commute an hour, so that could cause some problems. They thought, oh, no, this is going to be the way it's going to be. We'll never go back in the office. I said, no, that's not true.
Yeah, and I mean, we have a team of 9 people, and I could not imagine having people not in the office. And it's just so much harder to communicate. And I know there's different tools that, and again, I'm younger.
Right.
And I know technology, and I'm not a tech expert by any means, but I can utilize technology, I'm going to say, better than you can.
Right. Oh, that's for sure. I won't deny that.
But I just can't imagine not having that. And we work in the service business as well. So, I mean, I can't imagine not having that connection with the employees that we have.
Right.
And, you get to know them. And I tell you what, and we said this years ago as well, is you really almost become just another number many times you're working online. You don't have that connection with your coworkers, with your bosses. I mean, it's hard to build that. And I think that was a very kind of short-sighted mindset for a lot of people that were looking at it that way.
Right. And that's why we do like commercial real estate, Class A buildings in the right areas down the road, probably the next 12, 24 months. I mean, you've got to do it right. You can't just go out and buy any building. You've got to do it do it right there. But that's a trend that I think will be changing going forward to where more people will be coming back. I've not seen a report lately on how many people actually work from home now. I know it's a lot less than it used to be.
Yeah, I mean, it's more than it used to be if you look pre-COVID, but it's less than it used to be, obviously, if you look at the height of COVID. And it seems like that trend is kind of reverting back to more normalcy. And I'm quite confident in this, that the remote work will be higher than it was in 2019 going forward, but I think it's not going to be as much of a difference as people thought.
No, and funny too, I did see a report a couple of weeks ago that they said actually people coming back in the office are happier because at home they felt lonely, depressed. But when you come in the office, you got parties, you go out to lunch, you socialize. We're social human beings. So there is a positive to it as well.
And, kind of just on that topic of socializing, it is so funny. I was reading actually in Barron's, this is, maybe months ago, but they had an article about the people that were happiest in retirement were the social butterflies. They're the people that they set lunches with friends and they have groups and they do things.
Yeah.
I mean, the same concept. We're social beings. You need to have that human interaction. And sorry, just sitting on a Zoom many times is not going to be satisfying enough to the brain.
There is a good thing to go in the office. Well, let's talk about, and we did discuss this again years ago as well, so be careful of these, but the special purpose acquisition companies, also known as SPACs, another year has passed, and more data is on what a bad investment special purpose acquisition companies were, also known as, again, SPACs. I hate to tell people I told you so, but back when these blind investment pools were hot, we warned people. In 2022, the total write-downs amounted to $11.6 billion, which was a huge increase from the $2.7 billion in 2021. I can't wait to see what 2023 is going to look like.
And the reason for the write-downs is based on what is known as goodwill. This comes about when a business is acquired for more than the value of its assets. Now, accounting rules require the measurement of fair value to the assets annually. If that figure is less than the amount recorded in the books, the value of goodwill must be reduced. I've been in the investment world, or we've been in the investment world, more so you have been in the investment world, I should say, for 40 years. And I continue to see that these hype investments that make Wall Street a lot of money, unfortunately, in many cases, leave the average investor with losses. Now, this is why we continue to be value investors and invest in companies when they're on sale and then sell them when they're overpriced. It's a very simple concept,
Right.
but it's not always easy to do.
Right. And again, I've been doing this for over 40 years. There was always something hot for people to be sucked into. And right now it's I always get the letters wrong, chat, IBT.
GBT.
GBT.
GPT.
Yeah. That's the next hot thing. And you're seeing companies going up because, this and AI. AI's been around for a long time.
Yeah.
But here is another thing like the SPACs, like the meme stocks, another thing that people getting sucked in and bringing these prices way up, that the only thing that can happen is they'll come way back down again.
And I don't know, we at our workshop this past Thursday, and I said in honor of 420, we talked about the wheat stocks. And it's a big wheat holiday for a lot of people.
I didn't know when that was.
So I was like, in honor of 420, let's look at the marijuana stocks. I don't know if you were listening to me when I said this.
I think I was. But
Tilray, this was, again, another example of a hot topic, a hot stock. You guys are just wet blankets. You're missing it. Tilray in 2018 went from like $25, $30 a share all the way up to, I think it was like $150, $160.
Wow.
Today, $2 a share.
$2 a share.
$2 a share. Hey, sometimes being a wet blanket, I guess, isn't so bad.
Not so bad. And it is the hype that brings you in there. And again, we've talked before in the past about 3D printers, which actually now are really starting to be used more. But I don't believe the 3D printer company that was one that was back then, because their symbol is very easy to remember, DDD, went way up to I think 100, then went way back down to probably about $2 a share. I think now makes more sense. But we're now talking 15, 20 years later. And this chat, what is it again?
GPT.
This chat GPT, it will be there someday. But the thing is, it's not going to be there tomorrow to where all of a sudden it's making all this money and the stocks that you're going into or stocks are being pushed up because of it. It's a passing fad. It will come back down and it'll be replaced by something else that I can't even imagine what would be coming out.
And I'll tell you, it is so hard. Because there are going to be your Amazons, there's going to be your Teslas, and we miss those.
Yeah.
But statistically speaking, there's a lot more hype stocks that completely crater and you lose so much money than what actually results from buying and finding an Amazon or Tesla or an Apple. Those are, again, diamonds in the rough. Most people aren't going to be able to find those companies for the long term. Many of them end up folding, and it's amazing what those companies have been able to do, but to invest in those very, very early on, it's very high risk, and you have no idea. It's very easy to call the ball game, as we always say, after it's over.
Yeah.
But gosh, before the ball game starts, you don't know who's going to win necessarily.
Right. And the other thing, too, it flies against all the fundamental reasons on how to invest. Because to do it right, you would have to buy a Amazon, put your money into it, and then never sell it. And you did very well. But the thing is, as it did better, became more concentrated in your portfolio, which is against investment rules. You shouldn't be doing that. So it is almost a gamble. And there are some gambles that pay off. I know somebody's made millions of dollars in Vegas.
Yeah.
But it just doesn't fly correctly in investment rules.
Well, and it's very hard because, again, as I said, we'll use Amazon, where you've had periods where it goes way up and then it goes back down and then it goes way up further and then it comes back down and it goes way up further. It's going to have those pullbacks, but if you look over the long term, it's very easy now to say, it's gosh, there's people that have done extremely well on that stock.
Right.
But I'm going to use that Tilray example again. Do you think the people that held Tilray at $150 a share thought that was the end of the game? I'm sure there was maybe some that did well on it,
right.
But there was many others that thought this is the future. This thing's going to 300, 400. You always think it's going to go higher. Yeah, it's just so hard, and that's why if you have no discipline when it comes to investing, it's a losing man's game, essentially.
Yeah. Discipline is, we always talk about emotions, no emotions. Discipline is part of that as well, because you've got to have discipline to do it. And sometimes doing the right thing is not going to be what, after you look back in the past, darn, I wish I did buy Tesla back when it was $100 a share, and now it's, whatever. I made 10,000%, but that's not the norm. And for every one person that did that, there's probably hundreds that held on to some company that went to zero. Or
let's use Rivian as an example.
There we go.
People that many times like Tesla were like, oh, the Rivian or the missed Tesla. This is the other one. Like, I don't want to miss the next Tesla.
Yes.
And then you buy Rivian. Or you think that, that Rivian's the future, let's say, and you take your profits from Tesla and then you buy Rivian and then you wipe out all your profits because that thing's down, 90%.
That does happen. Yeah, that does happen. And it is true. It will cause you to do bad things investment-wise, because of the perfect example you said was, I'm going to take my profits from Tesla that I've made, and now Rivian's the next one, so I'm going to buy Rivian at $50 a share, and that's going to go up. I think Rivian's what, 12 or 13 now?
Somewhere
I think
around there.
with that. And then so you've got to have a discipline. You've got to have fundamentals to do proper investing, so you don't have those down periods. And I've talked to people before, like, yeah, at one point I had all this money, and I lost it all. Yeah, that same thing's going to Vegas. So it's exciting, but it doesn't hold true. Which brings me to our next topic here. Oh, and by the way, phone number's going to open the phone lines for you. 833-288-0973. And as always, that'll get you through for your unbiased, no strings attached, fundamental opinion about what you want to talk about. Again, 833-288-0973. Well, I know people are fearful about investing now, and when I tell them I expect to have a very good year come December 31st, I think they question my thoughts. Currently, value stocks are very inexpensive compared to growth stocks.
And they're actually discounted more than they have been for 4/5 or 80% essentially of the time in the history of the stock market. Another study actually showed as well that when inflation runs between 4% and 8% per year, value stocks outperform growth stocks by 6 to 8%. Now, people may be afraid of inflation, but it actually is a benefit to many of these value stocks. And yeah, we're going to keep investing here. And, we talked about down periods. And yeah, I can't give you the performance numbers, but yeah, we were down a little bit last year.
Yeah.
That's going to happen. It's so funny. You talk to people and it's like, yeah, out of a 7-year period, we're going to have a couple losing years.
Right.
I was down last year? How does that happen? You need to understand when you invest, there's losing months, losing quarters, and yes, losing years at times.
Yes.
Maybe, I'd love if we could make 30% every year. Who wouldn't love that? but that's not the reality of investing properly in the long term.
And on my computer screen in the office, right on the bottom of the screen, I do have, and it's taped on there because I can't put it on there, but it's taped on there, the performance for the last 7 years on the portfolio. And there are a couple losing years there. There's the good years, the bad years, and so forth. And I keep that there to keep on track. And what's going to happen is that you're going to have, again, the good years and the bad years, but you look through it and you remember those years. And I remember a couple of years, like, a lot of things came at the very end. They came when you least expected it. And the hardest part is, like, right now, nothing's happening, nothing's changing. Day goes up and it goes down. Next day, week up and down. But eventually, all of a sudden, you look back like, well, how did we get up 15%? Mm-hmm. And it just, things change. And the value portfolio that we talk about, I mean, when you compare the fundamentals or the valuations to these growth stocks, I just don't see how they're going to keep on going. I mean, well, do you know when like Apple and Microsoft report? Is it next week or the week after?
I assume it's coming up because I know it's normally. I mean, we're getting into the heat of earnings season. We got Tesla, Netflix. I would assume it's next week or the following week.
Because Tesla reported already.
Mm-hmm.
Yeah, they not so good.
Not so good. No, I mean they had contracting margins. They actually had declining net income. Sales were still up, but I mean, you trade at 30 times earnings. Your sales better be increasing. And I mean, the big thing that I think was a detriment to the stock was that their gross margins really contracted, and that was kind of one of the reasons why people were saying, oh, they deserve a higher multiple than the GMs and Fords and so forth, is because their gross margins are so much higher.
Right.
Well, those start to contract all of a sudden. There's going to be some problems. And I got to say, too, I know Elon Musk mentioned on the earnings call that he is not necessarily that concerned with selling the cars. Like, he's like, we could sell the cars at zero profit. It's more about building that base for future revenue. And I still I don't know. I mean, he's obviously a very intelligent guy. I just don't know how essentially they're going to capitalize off that software in a car. And I know there's the self-driving type stuff that they offer, and I think that is a monthly subscription.
Well, what about the charging stations? Will they
Maybe the
make money
charging
from that?
stations, they start charging for that, but I just...
Well, they do charge for them now, depending on...
Well, maybe charging more.
More,
Yeah.
Because once they got you, well, they can charge more. It's like...
But the only problem is I think you can use the other charging stations as well.
Mm-hmm.
So if you have, maybe, and if Tesla starts to increase the price of charging perhaps too much, then it creates that well, maybe I'll go. I think it's like EVgo or, Blink, or there's other charging networks. So there's going to be more competition there. And I don't know, essentially. I think people, of course, if they sold the cars at nothing, I mean, their margins would be atrocious.
Right.
And I think you're now talking about years away from really being a good margin business. And even then, fixing the cars, and I mean, they're still cars. They're still going to deteriorate. You're going to have problems with, the materials in the car. You're going to have problems with components and so forth. I don't see essentially that future of, the software in the car being like the software in a phone.
Here's another interesting fact for Tesla. Do you know they don't advertise? So that's a big expense for a car maker's advertising.
That's very
Will
true.
they change, because now they're lowering the price of the cars, I think 6 times now. Will they change to where they start advertising, trying to get more people coming in? That'd be another expense. It'll hurt their profit margins as well. I think the only other companies that are major size don't advertise, I think, are Ferrari and Lamborghini. But I think Tesla might say, you know what, we need to kind of advertise the new stuff we have, and they are losing market share because Ford, GM, Kia, Volkswagen, they are taking share from them. Now, Tesla's still the huge one, but you lose a little bit each month. And like, well, hey, we got to get some of that back. We got to tell people why they want a Tesla. So that could hurt their margins as well when they start advertising. So I'd be very curious to see if they do that.
Yeah, and I mean, you'll never catch me in a Tesla. I don't like them, and I think they're just so. You see them on the roads, and like the Model 3, the Model Y. I mean, those are the big. They all look the same to me.
Yeah,
and I feel like it's. I just don't like it when you see like 5 of them on the road, and you're like, I don't like that they're all the same,
Right.
And I like having the different cars. I'm sitting here looking out at the freeway, and you just see all the different types of cars on the road, and you like the differentiation rather than having every car be the same. And it just doesn't make sense to me of how Tesla can keep growing at the rates that they've been growing, and especially all of a sudden. What tells me they're having problems is that they're cutting prices so much to try and meet those deliveries that need to essentially occur to meet their production and delivery goals. And, as you said, they don't do advertising, but, kudos to them. They didn't need it. They built this kind of brand that, generated that type of attention without the traditional advertising methods. But they got to have some next act, essentially, to keep that stock even at the current levels.
Well, they got is a pickup truck actually coming out?
That beats me. I mean, that thing's been talked about for years, and it's so funny. Any other car manufacturer,
they'd be dead.
Oh, yeah. I mean, they'd be taking serious hits, and it's like, oh, well, maybe next year.
Next year.
Okay. Oh, no. Maybe next year.
Wait, what happened to their sports car? They had a sports car, too.
I don't even know.
Yeah, that's gone. But what I was going to say, too, is it reminds me of, used to watch these movies that are futuristic. And in the future, all the cars look the same. And I feel the same way when I go down. You'll see like 2 or 3 Teslas. It's like, that's ugly. They're all the same now. I don't want to be the same. I mean, I like the variety of different cars. And that is I don't want to say exclusive to San Diego, but I don't think it's the same way. We went to Montana. I don't know if I even saw a Tesla.
Yeah.
Yeah,
and I don't know. I don't get me wrong. What they have done is truly amazing.
Yes,
I mean,
yes.
and the business is very, like, if Tesla traded at, I'm going to say 10 times earnings, I would be very intrigued.
Right.
But it doesn't. I mean, that's the problem, is the valuation on the stock. And you have to get that growth going forward. You have to get those margins re-expanding. And I say you have to. The only reason you have to is because the stock is so expensive.
Right.
The stock wasn't trading that high. I mean, you could maintain margins and, just kind of keep on as business as normal. But, yeah, I mean, that's the danger with these growth stocks.
It's about investing into a business at reasonable valuations versus going along with a concept, which, again, great concept, great car, and so forth. but eventually that does fade. And all of a sudden you're left with nothing, and you start doing the crazy things where you sell it and you buy the Rivians because you think that's the next concept. So, yeah, I just looked over. We have all phone lines open. Phone numbers here, 833-288-0973. That's 833-288-0973. And you've got an equity, a stock that you're kind of looking at. Should you kind of concerned? Maybe it's a Tesla-type situation. We're going to say, should I sell this and buy something else? What should I do? That's what we're here for, kind of go with the fundamentals of the companies that you're looking at buying, selling, or holding here. So, well, Chase, I do want to talk about YouTube TV for NFL streaming. You may have heard that YouTube, which is owned by Alphabet, purchased the NFL Sunday ticket package for $2 billion per year for the next 7 years. Now, DirecTV had been paying $1.5 billion annually and decided to let the contract go. Downside is a full season of Sunday ticket will now cost $449 if you don't want to subscribe to YouTube TV. That is up from $300 that DirecTV was charging just last year.
And if you want the Red Zone channel as well, which is I think one of the more popular features of the Sunday ticket, that will also cost you an additional $40 for the subscription. Now, sorry about the bad news, but there is some good news, and that is if you sign up before June 6th, you actually get the Sunday ticket at a discounted price of $349, or again, a $100 discount. There are other ways to get a lower price, which include paying $72.19 a month for YouTube TV's base video package, which includes the major broadcast and cable networks there as well. And, you know, frankly, I've gotten the Sunday ticket the last few years. I don't know what I'm going to do here. I mean,
You had it? You didn't?
I've had it.
Had it?
Yeah. With DirecTV, I would get the Sunday ticket but I haven't watched football as much as I used to. And the thing that I hate about it is I would only really watch the Cardinal games.
Right.
So I'm paying $450 just to watch one team. And that's what just irks me. It's like, yeah, great, you get all of these different games, but I don't want all the games. I just want one. You know?
I'm surprised you do that. You're pretty tight with your money. And
football is you have, cars as a hobby.
Yeah.
Football is my kind of go-to, like that's, I don't want to say I'm okay wasting money on football, but I enjoy spending money on it. Yeah.
So, but by the way, all these topics we talk about and other ones like TikTok ban, we also talked about India's population, the lending capacity, streaming services. All this information you get for free on our website through our newsletter. It's a free newsletter. Just go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. You get like 10 to 15 different topics that we talk about that are real thought out, real planned out. People say they love the newsletter. It's just great information. And you can kind of pull out things you want to read. Again, free. But you got to sign up for it. It goes out every Friday around 5 o'clock. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. All right, phone numbers here, 833-288-0973. Let's go out to San Diego and speak with Val. Val, you're on the Smart Investing Show with Brent Chase. How can we help you?
Yes, I am interested in ABCL, Accelera. It's, I think, a Canadian-based biotech company.
Okay, and you said you're hold it or you're looking to buy it?
I have a very, very tiny initial position of 100 shares. I'm looking to perhaps add to it.
Okay. And I think the company again is Accelera Biologics, symbol ABCL. They're in the biotechnology industry, a big short float here. A lot of people shorting this stock, 15.2%. That's pretty high. Institutional ownership is only 46.5%. They do have a PE ratio that's not bad, 14.4, because the industry has nothing there. Price to book value, 2 versus 29.7. Price to cash flow, 8.2 versus nothing for the industry. No PEG ratio, same as the industry. We do see earnings over the last year are down 23.1%. Industry down 44.1%. Sales did decline for the company by 0.7%, but the industry was up 15%. Now, the 5-year growth rate for Accelera is 10%, which is very good because the industry is at negative 5.9, so it's the only positive I've seen so far. Looking at the balance sheet, a lot of liquidity here. Current ratio 8.7 versus 5, and debt to equity 0.0 versus 0.5, so a good balance sheet. We do see a net profit margin also very good, 32.7 versus negative 0.5, and return on equity 12.9 versus 43.2. there's a couple good things here, but I think it's really going to come down to you, Chase. What do you see going forward?
Yeah, so current price here for, again, Abacelera, ticker symbol ABCL. Well, it's $7.21. Wow, 52-week high here, $14.97. So it's essentially been cut in half. 52-week low, though, $5.42. I see year-to-date the stock is down 28.8%. Actually bigger than I thought it would have been. Market cap's about $2 billion, so decently sized company there. Going forward, though, unfortunately, I look out to December 2024, I see estimated earnings per share is negative 57 cents actually there. 6 analysts on it, which is, again, more analysts than I thought would be following this company, but I don't like that there's a negative estimate for earnings per share because we can't use our multiple to derive a target sell price. Now, this is obviously a biotech company, so it's just one of those very high-risk ones. I mean, if they all of a sudden it looks like they develop antibodies to treat infectious diseases and various other types of diseases, yeah, sure, the stock's going to do great, but if it doesn't come to fruition, they'll run out of money and the stock will have some serious issues. So it's really hinging, I think, probably on their patents and what they're able to get through. It's I'm going to say a little bit more of a gamble than what we like to get involved in.
Yeah, Val, and this is definitely a gamble stock. I did see the trend of the earnings are declining going forward as well. So, I mean, it's one of these drug companies, they hit something, wow, the stock could go back up to 14, 15, maybe 20, maybe 30. But they've got a balance sheet. They've got a lot of cash. They can weather the storm. You could be sitting here for 2 years and the stock going back and forth from 5 to 6 to 7 to 8 and back down again until they actually hit something. So it really is a gamble here. If they hit it, they'll do very well. They've got the fundamentals to do that. By that I mean no debt and a lot of cash, but it's going to be very patient with it.
And I also do see it doesn't necessarily come off as earnings many times. You have to dig through it, but they do have, it looks like, high stock-based compensation as they're paying a lot of employees via that. And also, too, high share dilution. It looks like they have a lot of convertible instruments that down the road can be converted to common stock if this does pan out. So there are some definitely risk factors to be aware of with this company.
Yeah, so my recommendation, and I'm conservative, I would not say to go with it. If you want to gamble, add a little bit more there. Okay, Val?
Okay, thank you.
All right, thanks for calling. Have a good one. Bye-bye. All right, that does open the phone line, 833-288-0973. That's 833-288-0973. And before we go to Jim, if you can be patient, we do want to talk to Harrison about financial planning here. So just hang with us there, Jim. We'll get to you next. Good morning, Harrison. How you doing this morning?
I'm doing well, guys. How are you doing?
Good. I love this one here because I know back when I started, well, before that, back in the 80s, when they started taxing Social Security, people were they were livid. They were going to rally and riot because you can never tax Social Security. So you're today talking about taxation of Social Security. What's going on here?
Yeah. So you're exactly right, Brent. 1984 was the year that Social Security started to become taxable. So when you work and earn an income, either through wages or self-employment, some of your income is withheld to pay into Social Security. If you're an employee, it's 6.2% of your wages, and then your employer also pays another 6.2%. And then if you are self-employed, then you have to cover both sides of that, and 12.4% of your profit is then withheld for Social Security. Now, these withholdings occur on an after-tax basis. So unlike 401k contributions that reduce your taxable income, when you pay into Social Security, it's not deductible. Then when you get into retirement and start receiving payments from Social Security, then it could be taxed again, along with, your other retirement income. So the issue is with other retirement income sources, you either get a deduction when you save it, or you can access it tax-free in retirement. But kind of to your point, Brent, the reason people were so upset is, with Social Security, you're taxed on both sides. Taxed on your income when you work, and then you have to pay taxes on it again when you access it in retirement. So on the state side, most states do not tax Social Security. There are some out there. The ones that do are Colorado, Connecticut, Kansas, Minnesota, Montana, Nebraska, New Mexico, and Utah.
Wait, and they do tax on it?
Yeah, and they do it in different ways. Some of it it's fully taxable. Some of it's partly taxable, but those are states that.
I was surprised. On Montana. I didn't think Montana taxed on anything, but I guess it got taxed on.
Yeah. So actually, Montana treats it the exact same way that the federal side does. So on the federal side, I'll get to in a second. I guess right now, actually. So on the federal side, the taxation of your social. Question.
But wait, you didn't mention California. You cannot tell me California doesn't tax Social Security. That is not California.
I was going to say that. Yeah, California. Most people listening are in California. California, for now, does not tax Social Security.
I think it's because it's a government benefit, and California loves government benefits.
It's the only thing that California has over everybody else that we don't tax Social Security. I'm incredible.
Yeah, so I mean that is something that could possibly change. I mean, none of the states used to, and then over time, some of them have started to implement taxes on it. But on the federal side, it can be taxable, and so what I mean by that is the taxation on your Social Security is based on something called your combined income, and your combined income is basically 1/2 of what you receive from Social Security plus all of your other income. So that equals your combined income. And then if you're married and your combined income is between $32,000 and $44,000 a year, then up to 50% of your Social Security can be considered taxable income. And then if your combined income is above $44,000, then up to 85% of your Social Security is taxable. If you're single, those numbers are 25,000 to 34,000. 50%, and then over that 34,000 is 85%. So as far as the planning comes in, your other income is taxable, and it can also cause more of your Social Security to become taxable. So if you understand how this works, you might be able to, in some years, structure your other income to be low enough where you can also get, free Social Security. But there's nothing else that is taxed the same way Social Security is, where it's based on your other income like this. So I wanted to kind of point out how that works.
Yeah, and this is why I don't trust the government, and also too, I'll say 15 years down the road, people don't freak out, but the debt now of the government is $40 trillion. Wait a minute, we've got all these people that have now trillions of dollars in these Roth IRAs that they're not paying taxes on, but yet they're making good money. Maybe we need to do a special worksheet for them like we did back in '83 with the Social Security. I mean, I just don't trust the government when it comes to taxation.
And, in addition to that, 1983 is when they proposed the legislation, then it went into place in 1984. Mm-hmm. But those, the break points I was talking about, 32,000 to 44,000, those numbers have not increased over time with inflation. So in 1984, $32,000 is equivalent to around $93,000 today. And so when they implemented that in retirement, a lot of people still weren't paying taxes on Social Security. But over time, as inflation has occurred and as incomes have gone up, more and more people are having their Social Security subject to that tax. So it's kind of like a silent tax, if you will, because of the way that it's calculated.
Right. And this is why financial planning is so important. I know you did say there are some ways maybe you structure your income, maybe you can miss taxation some years, but it's just unfortunately those, what do they say, two things you can't avoid, death and taxation, and even on the Social Security, it is there. And it's just, it's a shame, but it's reality.
Yeah, and that's exactly right. We can't really control, how much you put into it. It's based on your income, so that's automatic withholding. And then in retirement, for a lot of people, there's going to be a lot of years where it is taxable. So all you can do is choose the best Social Security strategy to, benefit your overall situation the best, and then try to reduce the taxes, when you can. Which there are ways to do that, but you have to understand how it works. So that's the point.
And Harrison, you're kind of funny too, because you mentioned about how it's double taxation. They tax you when you earn it, and tax you when you receive it. Kind of like in a corporation, where they tax a corporation, then they tax the dividends as well. The government has a couple of things where they do double taxation here. So
Yeah, exactly. That's another one that comes up is corporate earnings.
Yeah. So, well, Harrison, thank you very much. Great information. Unfortunately, it's the truth, but people got to know about it to try to help deal with it. So, thanks for I was going to say coming in. Thanks for calling in, and we'll see you on Monday.
All right. Thanks, Brian. We'll see you Monday.
Okay. Bye-bye. Again, that's Harrison Johnson. He's our CFP, our financial planner at Wilsey Asset Management. If you'd like a free consultation with him, again, there's things you can do that are going to benefit you on taxes and your cash flow and things of this nature. It's a free consultation. He is not a commission salesperson, does not sell annuities or life insurance. He is a fee-based planner that is with Wilsey Asset Management, but also separate from Wilsey Asset Management. You can give him a call at the office, 858-546-4306. That's 858-546-4306. Or go to the website. You can contact him by email there, smartinvesting2000.com. Again, that's smartinvesting2000.com. And I promise you, when you talk to Harrison, we've had other people come from other financial planners, and they say, he covered so many things. My other guy didn't talk about it with him for years, and he never covered half what Harrison covered.
Well, there's a big difference between asset allocation and financial planning. But unfortunately, a lot of advisors sell financial planning via asset allocation, which that's not really true financial planning.
Right. Financial planning does a lot. And I've seen Harrison, the workshop, which had a great workshop this, Thursday. Mm-hmm. He gave people a lot of information on that. So, and again, you can do the same thing. Just get a free consultation and just go to the office. Smartinvesting2000.com. I was just ready to go to our call, and I looked over, and he disappeared on us. And I did pull up what he wanted to talk about. If I do forget his name,
I think it was Jim.
I think he was calling about Amcor technology. The symbol is AMKR. Then the semiconductor industry. So we'll go this for the Jim. Hope you're still listening here. They do have small amount of float on the short side, 5%. Small institutional ownership, 39.3%. We do see now, this is a semiconductor company, so this is pretty good. The industry average PE for semiconductor industry is 22.8. Amcor is 7.5, so that's a good start. Price of sales, 0.8 versus 4.8. Price to book value, this is tangible book value, 1.6 versus 330. And by the way, I looked at the price to book value. This company has no intangible assets. That's incredible for a tech company. 1.6 tangible book value. Price of cash flow, 5.3 versus 14.2. PEG ratio going forward, 1.9 versus 8.8. They have seen over the last year their earnings increased by 10.3%. Industry up 12.7, a little bit better. Sales for the company up 10.7, far better than the industry growth of 2%. Now, the 5-year growth rate estimate from the analyst is 7.5% for the company, 11% for the industry. We do see a dividend of 1.3%, but they only use 7.2% of the earnings to pay that out. On the balance sheet, got a current ratio of 2. Yeah, that's okay. The industry's at 2.9. Debt to equity 0.4 versus 0.6, so that is positive for the company. Net profit margin 10.8. That's about half the industry at 21.3. And return on equity for Amcor Technologies is 20.9. We're happy with that. Industry is higher at 25.8. Chase, what do you got going forward?
So I did look and see what this company does. They actually are a provider, it looks like, outsourced semiconductor packaging and test services to integrated device manufacturers, fabless semiconductor companies, and contract foundries as well. They're also headquartered in Tempe, Arizona. So I know that there's actually a decent amount of investment flowing through to semiconductors foundries in Arizona. I wonder if that'll benefit them. The other thing I noticed is roughly a third of the revenue is generated in the United States, with the rest coming from China, Ireland, Japan, Malaysia, Taiwan, Singapore, and countries across the world. I would want to know, again, how much comes from China. That has always been something that, it's a difficult kind of space, because we know that they are a large manufacturer, essentially, and these companies don't necessarily have operations there, but they sell to the manufacturers in China. So I'd want to understand that relationship, because one thing we've talked about is, China's done before in the past where they come in and say, no, we're just going to take your technology. Goodbye.
Goodbye.
So it's, again, something to consider. It is a risk that you have to understand if you own the company. So I want to understand a little bit more about the relationship with China there. Looking at the current price, though, for Amcor, it is $23.43. 52-week high is $31.38. And the 52-week low, well, it's $14.89. Now, if I go out to December 2024, I do see estimated earnings per share of $2.83, would give us a very attractive target sell price of $46.98. So a forward PE essentially about 8.5 times. I mean, that's valuations are very good on this company. Also, too, I talked a little bit about the concerns, but the thing that I will point out as well on the positive side is we know that semiconductors have gotten kind of beaten up here, but on the positive side, we know that people are still going to need semiconductors, and we're going to need a lot of semiconductors in the technology that we're kind of implementing here over the next decade. I like the space. It's just a space, of course, you have to be a little bit cautious with because of the, I'm going to say, global supply chain and understanding what China could do.
Yeah, and that's the big factor with China because you always got that fear what they're going to do. I did notice too that the earnings over the last 9 days, the estimates going forward are down about 13%. So they are pulling those down a little bit. But I still have not finished. I barely got it started yet. That book on the chip world. I want to read more about the chips because I just don't see how chips in the future are not going to keep growing. Because they're used in more and more things. And you want to be in chip companies going forward, but you got to find the right chip companies, not ones that become obsolete.
And you have to understand as well, one of the reasons that many of the semiconductors have gotten beaten up so bad is because of the PC market.
Yeah.
And PCs, of course, are a huge user of chips. Well, they really pulled for that demand. The PC market, I think, they've seen declines of like 30, 35% in some cases year over year in terms of the sales. Well, they have so much inventory that the chip companies that need to produce more chips for those PCs that it really kind of created a difficult market. So it did bring down a lot of chip companies. But again, longer term, it seems like a lot of these chip companies are trying to diversify that business into kind of new spaces. We've talked a lot about kitchen appliances now use a lot of chips. Yeah. Cars use chips. I mean, there's a bunch of different industries that need chips, and it seems like that is continuing to grow, which should help diversify away from the PC business. And I like the space. It's just one you have to be cautious in.
And you brought up the PC market because, again, we had that big purchases during COVID because everybody had to have one to be home, work from home, and so forth. I believe to say that I thought, correct me if you know something different on this, that the average life of a PC, I think, was around 3 years. Does that sound normal?
I've had my Mac since 2015, but right. I've also had my iPhone since 2015.
Right. Yeah. Well, you're the exception, not the rule. Yeah. But that's what maybe we'll do a post on this next week and put in the newsletter because it is something I'm kind of wondering. That number's in my head, that 3 years. Now, it could be in past time frames, but also, too, I mean, people do drop them. They break them. They get, spilled water on them. They want something new. Everybody wants something new. And my feeling is you don't need to get a new iPhone every single time they come out. They got the number 25 coming out. What comes up next in September? Is it 15? I don't know what number they're on.
Yeah.
But you don't really need a new iPhone. Same thing with a PC, but you want a new one.
Yep.
The keys get dirty, they kind of stick or whatever. Like, you just want the new one. They're not that expensive. So I think we could be seeing maybe next year the PC market change where it starts increasing again.
Well, and I think just by the nature of that volatility that we saw and the huge spike and the huge decline is now we've kind of bottomed and hit that trough.
Yeah.
It's just naturally you're not going to have another huge decline. It could level off and then slightly increase. And I do have the number if you want me to give it.
But please. Let me know. Was I close?
You were close.
Okay.
For most desktop PCs, you can expect a minimum 3-year lifespan.
Okay.
But the average survives around about 5 to 8 years is the average lifespan there.
Okay. So we'll say 3 to 5 probably sounds like a good number. And again, there's many PCs before that time frame that were bought before 2020, we'll call it, or 2021. So, and I think you're right. You hit that bottom, and when it starts going back up again, and it's not going to be like a big jump, but it changes.
Yeah,
that's when. Oh, wait a minute, we do need more. And again, you talk about chips and toasters and refrigerators and all kinds of things are going to be used in everything. They might be used in even toothbrushes for some reason. Who knows?
Well, and what's crazy? I was just looking at the date here. COVID was 3 years ago.
Yeah.
So we're kind of starting to hit that 3-year time period where, people were really kind of buying them in 2020, probably early 2021. So we're kind of starting to brush up against that, where that minimum 3-year lifespan is kind of starting to get hit. So you could maybe see, maybe it's a year, maybe it's 2 years, where that market does substantially recover.
Right. And that's how you look at investing, how things are going to change and so forth. And you may not get the absolute bottom. We say we'll never buy at the absolute bottom or sell at the absolute top. But if you get it at a reasonable price, sell at a reasonable price, you do pretty well. I do want to, since we got time for somebody else calling now, 833-288-0973. That's 833-288-0973. Got about 10 minutes left here. If you get in quick, we can answer your question. But I wanted to go to something that's kind of unique that I saw this, and it talks about India's population. It appears that this year, China will lose its top spot regarding having the world's largest population. It is predicted by the end of this year, India's population will stand at 1.429 billion, more than China's population of 1.426 billion. Now, India is the world's largest democracy and is a natural partner and investment destination for the United States.
The economy in India suffers from a 16.4% of the population living in poverty and a labor force participation rate of only 39.8%. That many people, it's harder to find that many jobs, I guess. Right. But it's well below the U.S. participation rate of 62.6%, so a huge discrepancy there. Now, the job market is so tight in India that when they posted 35,000 job openings for their national railway system, this is impeccable, more than 10 million people actually applied for jobs. The good news is that as relations with China continue to have concerns, perhaps some of those jobs could move to India. Currently, production line workers in China make 5 times the salary that would be paid to a worker in India as well. So there is some potential to have that supply chain efficiency improved in terms of the cost and also diversification in a new geographic location as well.
And I know many people from India. They're all very nice people. Yeah, they're just nice,
hardworking too.
Hardworking, smart. Smart. We just talked about the PC market. Perhaps more PCs as the India population changes, because again, there's a lot. 16.4% in poverty. As they start coming out of poverty, they can start buying PCs. And you're now talking, 1.4 billion people. That could be another change. So that's why investing is so fascinating. I've been doing this for over 40 years. That's why I say I hope to be doing it for another 40 years. It puts me at 100, but it's just,
over 100.
Over 100. It just is so fascinating when you look at how things change. And the problem that people get is they want it to change tomorrow.
Yeah.
It doesn't do that way. It's over time. That's why I love reading the Wall Street Journal, Barron's, seeking out for all this stuff, because it's so fascinating how things, we see them going forward. This thing with India, it's not going to change tomorrow. But as years go on by, it's going to change the world, and going to change the country here. And we always think about, too, when we talked about the PC market, we're talking about here in the U.S. Did forget about the entire world in India.
Yeah, no, absolutely. And I know that I'm not saying to go buy the stock because of this, but Apple, I know Tim Cook was there recently and talking about, I think they opened their first store in India. And they've been doing sales in India already, but I think it was their first store that they opened there. And he says he thinks India is going to be a very bright market going forward. Yeah. And I think so too. I mean, obviously the potential is there with just the massive population they have. Right. But I think if they can get the infrastructure up and running, I mean, there's a huge opportunity, especially for a potentially increasing middle class in India. There's a lot of opportunity, I think, there. And I think you're starting to see more companies invest in that as well.
Right. And we like Apple. I mean, I have the product, you have the product, and so forth. But it's just, we don't knock the company. It's just the stock is very pricey. I think that stock could be in their trading range from 140 to, we'll call it 180 for years to come, because they do things like this. They're going to India, which I think they're going to have good demand and so forth. But what about Samsung? Samsung's not just sitting back in Korea saying, "Oh, we're not going to go to India." So they could be there. And I don't know, is Samsung? Here's another one. Maybe you can look up if we're talking more. Are they increasing or decreasing their market share? Because I've seen some of their commercials, and I have considered maybe I should get that phone. It looks pretty good.
It just makes it so hard to get a new phone. That's why I haven't gotten one. It's just too much of a pain. You got to go to the store, change the chip, make sure your contacts are. I'll just keep my phone.
I know,
but I don't know the market share there. And the other thing as well is, I don't believe India and China have bad relations.
Right.
So I think there's other Chinese manufacturers as well that could be looking at India as a potential bright spot there to kind of grow their business.
Right. Yeah, India, I don't think they have problems with anybody that I know of. And I could be wrong, but they're almost like Switzerland. Like, they don't have any problems with anybody. Just like, we're just in the world. You want to do what you want to do, fine. We're going to do what we do. Don't try to tell us what to do. They could be a very good country, superpower-wise, down the road. And I'm probably talking 30, 40 years. But things will change. They've got the people. They've got a democracy. People want to deal with them, do business with them. So...
Yeah, no, I think so too. And I was going to say as well, when you were talking about just, looking down the road, and I've had this conversation more and more with people lately, and they're like, well, why would I take that risk when I can get, 4% in a money market now?
Right.
And the thing that you have to understand is, and I was telling somebody the other day, I said, it feels good.
Right.
To do that, because you don't have to worry about the up and down movement, and it feels like you're doing something to get a guaranteed 4%. Well, the money markets aren't necessarily guaranteed 4% because they will fluctuate up and down. But the thing
T-bill, use a T-bill.
Yeah, T-bill is guaranteed by the full faith the government, which some people are scared by, but
it's still the best game in town.
Yeah, but you look again 5, 7, 10 years down the road, there is a huge discrepancy between earning 4%, 6%, 8%. If you double that, I mean, that is a huge change. And just because you were scared of a little bit of volatility for a couple of years, that cost you so much money in the long term. And we know that stocks, businesses, they're going to continue to grow.
Right.
And it doesn't matter necessarily who's president. It doesn't matter necessarily what's going on the global stage there. Businesses will find a way to continue to grow their business, to improve their products. And that's why stocks long term are a great place to invest, as long as you're doing it properly.
Right. And years ago, I did do analysis saying if you bought a stock at 10 now, and it went down to 8, but then 3 years down the road, it was like at 20, you did so much better than had you not bought it at 10, put your money in that 4% T-bill. A year later, you bought it at 12. What's a big deal? $2, $3, whatever it may be. The compounding effect is unbelievable, the difference that you make over the long period of time. And that's why I tell people, yeah, as you said, you may feel safe with that 4%, 4.5% T-bill now, think you're doing the right thing. Yeah, it's like the old story. That's where this tale came in, the tortoise and the hare.
Yep.
The hare, you're being the hare, like, yeah, see, Brent, you're flat, you're up 2%. I got a 4%, 5% guaranteed. I'm doing far better than you. So that's okay. Let's see where we stand 2 or 3 years down the road, because maybe today, tomorrow, I'm buying a company at $10 a share that you can't get now because you liked your money up into that T-bill, and then you get it at 12. I'll do far better than you. That's one of our secrets is investing when the crowd doesn't feel good. And I know, as you said it, you feel so happy with that guaranteed rate. You're hurting yourself long term. And that's probably why many people are bad investors, because they don't see beyond that. They just see the comfort now. Oh, I'm okay. I'm safe now.
And I had a conversation with somebody the other day as well. And I said, I would never do that. I said, well, what do you mean? Why? It's a guaranteed rate. And I said, because it's not the right thing to do. And, then I had another conversation. Yeah, but I'm down over the last month. And it's been 1 month.
Right.
And yeah, that T-bill has gone up a little bit because you got essentially the guaranteed interest there. But again, you look not over the next month, 3 months, 6 months, 1 year, you're looking longer term. And yeah, there's going to be time periods where it's like, it would have been better to buy the T-bill over the next 6 months and then buy. Yeah. But you're playing this dangerous game. And I don't want to say I would never buy a T-bill. If I had some liquid cash that I needed to set aside, that's what they're for. T-bills are not for your investment money. There's a big difference between your liquid money and your investment money, and they should not be intertwined.
Yeah, it's for a destination where in 6 months or 12 months, I need that money for a building or something else. But if don't fool yourself that you're being a short-term investor when it's long-term money.
Yep.
And 100% of my long-term money is invested, not in T-bills. All right. Gosh, there's a closing bell already. So thank you for listening to Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. And be sure to visit our website, smartinvesting.com. smartinvesting2000.com. That's smartinvesting2000.com. Got more great information there. Don't forget about that newsletter there. Sign up for free. Thanks for listening to Smart Investing Show. We'll be back next week right here on the Smart Investing Show.
So amusing to think that I did all that, and may I say, not in a